Hello my friends, and welcome back to the Financial Freedom Show with Chase Lawson. For those just meeting me, my name is Chase Lawson. I am a personal finance fanatic and the author of the best-selling book, Financial Freedom, Breaking the Chains to Independence and Creating Massive Wealth. I've spent a lot of time throughout my life learning all things personal finance, and with each episode, bring you a different topic with the goal of making personal finance simple. Thank you so much for tuning in today. If you haven't yet done so, please be sure to subscribe so you don't miss any future content. And if you like what you hear today or get any value out of this episode, please let me know by liking this or leaving a review on whatever platform you're listening on. Now let's dive into today's topic, which is a great one. Today I wanted to touch on a question I get a lot from people. They may be struggling trying to pay off debt while also trying to balance investing. Pretty much everybody has heard how much of a good thing investing is, but a lot of people just don't feel like they even can because they may have mountains of debt they're trying to climb, be it student loans, car payment, credit card debt, you name it. And so if you have extra money coming in each month, after accounting for other expenses, it becomes an important question. Should you use that money to pay your debt down or throw it in the market? Look, it's no secret that debt is a major problem in America. Pre-pandemic, the average American had $5,700 in credit card debt, which I'm sure is now only higher. In addition, student loan debt in America is approximately $1.7 trillion and continues to rise. Even our national debt is over $27 trillion, or $82,000 per American citizen. So it is important to tackle your debt before it becomes an even larger problem. However, as with all things personal finance, this is personal and is situation specific. There isn't necessarily a magic one-size-fits-all solution. However, in this episode, I will dive into some of the important factors to consider as you weigh out this decision and give you my own opinion on the subject. First and foremost, not all debt is the same. There is what is considered good debt by some. For example, mortgage debt and student loan debt isn't necessarily bad. You have to live somewhere, and a mortgage allows you to build equity in your home as opposed to throwing it into a sinkhole or you to rent, which I discuss in my episode on should you buy or rent your home. And a college degree is required for most jobs in America, and those with higher education are typically paid more than those with only a high school diploma. Further, you can use the interest on a mortgage or on your student loans to deduct from your taxes, so the impact is lesser with these types of debts than say with credit cards. However, you don't need a mansion and you don't need to go to the most expensive out-of-state school you can find. These are choices you'll have to make, but just know that not all debts are the same. Another important criterion to consider is your time horizon. For example, if you're in your 20s or 30s, you likely have several years left until you stop working, whereas if you're in your 50s and 60s and coming up on retirement, you have a much smaller window of time. The longer time horizon you have until you stop working, the greater potential payoff you could enjoy with investing over reducing debt, since historically the stock market has returned 9 to 10% per year over a long-term horizon. There is an easy way though to determine what is the smarter decision based on a pure dollars and cents standpoint. All you have to do is look at your after-tax cost of borrowing compared to the after-tax return on investing. For example, let's say you had a mortgage with a 4% interest rate. For most taxpayers, they can deduct 100% of the mortgage interest they pay throughout the year. So if you are in the 24% tax bracket, the after-tax cost of borrowing is only 3.04%, which you can calculate by multiplying your interest rate times 1 minus your income tax rate. For student loans, depending on your income level, you may be able to deduct directly from your income the lesser of $2,500 or the amount you paid in interest on qualified student loans throughout the year. So you can calculate what that rate is by multiplying the interest paid by 1 minus your tax rate and divide that by your loan amount to determine the true after-tax cost of borrowing. Other types of debt, such as credit card debt or car loans, are not eligible for any tax deductions, so the interest rate you are charged on these debts is the same as your after-tax cost of borrowing. On the other end, what about your after-tax return on investing? I've previously discussed tax-qualified plans such as 401ks and IRAs, but for non-tax qualified accounts such as standard taxable brokerages, you are taxed on any income earned from investments. This includes interest income on bonds, CDs, and savings accounts, dividends paid from stocks, and profits made when you sell investments that have appreciated in value, otherwise known as capital gains. The challenge with investments is it's not always easy to know what rate of return you will earn with these unless you're locked into a certain rate, such as is typically the case with bonds and CDs. As a result, you may have to approximate based on the rate you anticipate earning. As mentioned previously, the stock market has historically returned between 9 and 10% per year over the last 90 plus years. There will be down years in the market, but over a longer period, it is reasonable to expect that to continue. So if you then multiply that rate by 1 minus your tax rate, you can calculate your after-tax return on investing. For example, if you anticipate 10% annual returns on the market and are in the 24% tax bracket, your after-tax return on investing becomes 7.6%. Then it just becomes a math problem. Whichever side is bigger is the side that you should put your excess money to. And if you have multiple debts, then it probably makes sense to start with the highest interest rate balances when comparing it to your potential after-tax return on investing. However, as Zach and I discussed in the episode on debt payoff strategies, this is personal, and what makes sense on paper isn't necessarily the best approach for everyone. And you don't have to make this an all or nothing decision. If you want to divide your money evenly between debts and investing, you can. There's nobody stopping you from doing that. However, before you spend any money on investing or paying down debts, there's first a few priorities to make sure you have covered. First, make sure you have enough cash saved. It is advised to keep a 3 to 6 month emergency fund in the event you lose your job or have a major unplanned expense come up. In addition, always make sure to make at least the minimum payment on all of your debts, as failure to do so could destroy your credit, as I discussed in the episode on what is a FICO score. Finally, take full advantage of trying to max out your company's 401k match if available. Most of the time, that is an instant 50 to 100% return on your investment, which should outweigh any debt interest rates, hopefully. If these are not met, you should focus on those prior to tackling anything else. Only after taking care of that baseline should you then ask the question of pay off debt versus investing. Finally, it is also important to consider your own emotions and factor in the potential emotional burden which may weigh heavily on your life. For some people, it is important for them to be debt-free. They don't want the emotions associated with having any debt whatsoever. If your debt affects your overall peace of mind and leads to excess stress, then you can throw this question out the window. For you, it's probably going to be smarter to start with your debts. If even a low interest debt keeps you up at night, then definitely keep your mental health in mind, and in the event of a toss-up, it might make sense to prioritize paying down debts prior to any new investments. But if you simply just want to come out ahead and aren't unsettled by either option, then run the numbers and figure out which makes more sense financially. For me, I tend to think based on logic and seeing the bigger picture as to what's going to likely be better financially long term. That's why, in my opinion, debts like student loans and mortgages and often even car loans aren't worth overpaying on, since the interest rate on these are often below 6%, and I know I can earn more in the market. However, other debt like credit cards should be paid off as quickly as possible, since their interest rates are often 16% and higher. But like I said, make the decision that's best for you at the end of the day. I can only give you guidance and advice. It's up to you to apply it. Thank you so much for tuning in to today's episode. Hopefully you learned some valuable info to help making this tough decision. It certainly isn't black and white. There's always gray area when it comes to personal finance. The important thing is to make a decision and act on it after knowing all of the facts and analyzing your particular situation. Things will change, so be sure to revisit this as your life situation does change. Once again, if I can make an ask of you, please go ahead and like this episode or leave a review if you got value or liked what you heard today. This small act of yours means the world to me and helps others find this content. Let me know if you have any questions or comments or want me to cover any other topics in a future episode. And please be sure to subscribe so that you're among the first to get updated when any new episodes get released. Thanks so much, and until next time, stay safe and go get 'em.